Still above 161. Let's get to Bob Pisani. Hey, Bob.
Happy Friday, everybody. And you're right, Carl. Yields are smacking around the stock market again. So what we're seeing is the stimulus is pumping the global economy, and it's moving bond yields, and that's affecting the markets. Let's take a look at the sectors. Banks, of course, a big winner. They've been a big winner this week. Bank up about 6% as a group here. Energy is holding up in industrials. There's your reflation trade, which continues to be strong. What's lagging? The two sectors most sensitive to moving yields, which would be tech stocks as well as China. China's been lagging all week along with technology, and they tend to move pretty much hand in hand. So where are we with this whole story about markets and Treasury yields? It's complicated, but basically this whole narrative for higher yields is really, really powerful. You can just feel the market, the yields want to move up at this point. Stimulus is the big mover for global growth. What have we had? $6 trillion in stimulus in the last year? That's 30%, 25% of GDP of the United States. Those enormous numbers, bigger than we've ever seen here. And then we have the inflation story, transportation bottlenecks adding to price increases. Hope people think that'll go away eventually. But you get the idea. This is very powerful, this narrative for a higher move up in yields. And because of that, you get that growth value yo-yo, I call it. And value is winning, at least this week. There you see the bank stocks. Great week for bank stocks. They're up about 6% as a group, as I mentioned. There's the big money center banks. The regional banks also having a good week. The reopening play, retail, for example. These retailers have gone bonkers this week. They're all up double digits here. Well, there's the growth stocks I'm showing you here. So you see Tesla, PayPal, NVIDIA, Microsoft, all to the downside. They tend to move to the downside on what we've seen. But I mentioned earlier, retail stocks have been doing great. Macy's was at a new high. They're flat to slightly up today. So that's a good sign overall, that reopening trade that we're seeing. If you're confused about all this, growth versus value, what do I do? Banks, do what Jack Bogle did. Own the indexes. The S&P 500 was a new high yesterday. And why would you worry? Why would you want to worry about growth versus value? Let the nerds worry about it and own the broader indexes. I'm acting like Jack Bogle, but I am a Jack Bogle disciple, of course. Finally, just to make a quick note about active versus passive management, we have some of the best hedge fund people in the world on, people who are legendary and do outperform the market. But it's important to remind everyone, most people don't. Most active managers are terrible long-term. S&P Global every year does a study of active managers against their benchmarks. The year-end study came out yesterday for December 31st, the whole year. And once again, numbers are bad. I'm looking here at growth funds here, big active growth funds. 1 year, 60% underperformed. 2 years, Carl, 3 years, 69%. And it gets worse when you go out even to 10 years, 82% of active fund managers underperform the S&P 500 when they use the S&P as a bogey. So, Carl, we do have the best people on CNBC, the guys who do outperform, but most of them don't. And another reason why Jack Bogle became famous, shooting against those people.
Shepard Smith here. Thanks for watching CNBC on YouTube.